Welcome to the Deep Dive. We're your shortcut to really understanding what's driving company performance after earnings calls. Today, we're jumping right into Cenovus Energy's second quarter 2025 results call. We'll pull apart the key financials, look at the operational highs and lows, and try to figure out what management is really signaling for the future.
Absolutely. It was, well, quite a quarter for them, marked by some pretty big operational challenges on one hand, but also, some impressive execution on the other. We'll dig into how they handled all that, what it means for their big growth projects, and importantly, the financial path forward. You're going to get a really solid handle on what actually mattered from this call.
Okay, so let's start with that big picture then. What were the headline numbers for Cenovus in Q2? What really stood out?
Well, the financial resilience really shines through. Cenovus generated $2.1 billion in operating margin.
Okay, $2.1 billion.
And about $1.5 billion in adjusted funds flow. That adjusted figure is basically the core cash from operations before working capital changes, a good health indicator.
Right.
And they kept working on the balance sheet, too, reduced net debt by another $150 million or so.
So where does that leave their net debt now?
Ended the quarter at $4.9 billion. So making steady progress there.
That definitely sounds like a strong base. What about returning cash directly to shareholders? Were they focused on that?
Oh, very much so. Incredibly focused, actually. They sent back a hefty $819 million.
$819 million. How did they break that down?
It was a mix. Dividends, share buybacks, and they also redeemed some preferred shares. On the buyback front specifically, they bought about $300 million worth of shares using their NCIB program just in Q2.
Okay, the normal course issuer bid.
Exactly. And they didn't stop there. They kept buying after the quarter ended another $129 million by July 28th. So definitely committed.
Those financials are strong, no doubt. But you mentioned challenges earlier. Was there an operational event that really tested them this quarter?
Yeah, the big one was definitely the Carebe Lake wildfire in late May. That was a major test. Their response was, frankly, remarkable. Think about it. Over 2,000 workers evacuated. Facilities like Christina Lake shut down in an orderly fashion, and yet, within a single week, they had production ramping back up to 250,000 barrels a day.
A week?
Yeah.
After evacuating 2,000 people.
Exactly. Involved restarting over 50 kilometers of steam lines, 26 boilers, getting everyone back safely, and 0 asset damage reported.
That's incredible operational agility. Really speaks to their preparedness.
It really does. Safety and execution front and center.
Okay, let's definitely unpack this more. We've got the snapshot. Now let's, peel back the layers on the operational and financial details that really shaped Q2.
Yeah.
Starting upstream, how did production hold up with those wildfires and the planned maintenance you mentioned?
Yeah, upstream production came in at 766,000 barrels of oil equivalent per day, or BOE per day.
766,000.
And the key thing is they hit that number while doing major turnarounds at Foster Creek and Sunrise, which, by the way, finished ahead of schedule. Plus managing that Christina Lake wildfire disruption and also a separate steam release issue they had at Rush Lake.
Right, quite a bit to juggle. You mentioned Christina Lake's recovery. How quickly did they bounce back? And tell us more about this Narrows Lake tieback. What's the significance there?
Christina Lake came back strong. Average production was 218,000 barrels a day in Q2, despite the shut-in. And it was actually running above 250,000 barrels a day in July, so a really robust recovery.
Narrows Lake.
Yes. The Narrows Lake tieback to Christina Lake, that's a big deal. It achieved first oil in July. Technically, it's quite an accomplishment, but what it means practically is they expect a lower steam oil ratio.
Meaning less steam needed for the same amount of oil. More efficient.
Precisely. Less energy input, better efficiency, sustain higher production rates. It really maximizes the value of that whole Christina Lake asset by leveraging existing kit.
Makes sense. Now, West White Rose, that's been a huge project for them for years. What was the update this quarter? Why is it such a pivotal moment?
West White Rose had a massive quarter. Both the huge concrete gravity structure, the CGS, and the topsides.
The main processing facility part.
Right. Both were transported and installed offshore. And importantly, ahead of schedule. It even included a world first transferring that massive topside directly from one ship to the pioneering Spirit crane vessel. Pretty cool.
So installation done. What's next?
Hookup and commissioning have started. They expect to start drilling from the platform before year end. And first oil is targeted for Q2 2026. It's a critical turning point because it fundamentally changes their capital profile.
Okay, you said it transforms their profile. Explain that. Why is West White Rose such a massive financial deal? It sounds like more than just adding barrels.
It absolutely is. Think about it this way. For years, Cenovus has been sinking over $800 million annually into building this thing.
Capital expenditure, right?
Right, a big outflow. Once it hits full production, expected around 2028, 2029, that $800 million investment flips. Instead of spending that money, it's projected to generate roughly $800 million in free cash flow each year. And that's assuming, fairly conservative oil prices like $60 WTI.
So it goes from an $800 million drain to an $800 million generator. That's a $1.6 billion swing.
Exactly. It's a fundamental shift from capital consumption to serious cash generation. Frees up enormous capacity.
Got it. Were there other, maybe less flashy upstream developments that investors should be aware of?
Yeah, definitely. Over at Foster Creek, during their turnaround, they tied in 4 new steam generators. These came online in July. These aren't small potatoes either. They add about 80,000 barrels per day of new steam capacity.
Part of an ongoing optimization project, right?
Correct. First oil from that specific project is still on track for early 2026. So steady progress on boosting existing assets.
You also flagged a steam release at Rush Lake earlier. How significant was that incident? What's the latest there?
Right, there was a casing failure in an injector well, led to a steam release, localized thankfully, but it meant shutting in both Rush Lake facilities, which impacts about 18,000 barrels a day.
Ouch. So what's the plan?
Well, out of caution, they've actually pulled Rush Lake volumes from their guidance for the rest of this year. They're working with the regulator on the investigation. Management seems confident it was isolated to that one well, though. No broader concerns for their other Lloydminster projects.
Okay, that covers the upstream pretty well. But Cenovus is integrated, big in refining too. Let's shift downstream. How did those operations perform, especially after all the maintenance they've been doing?
Downstream actually had strong results overall. If you exclude some inventory effects and the turnaround costs they expensed, they generated about $220 million in operating margin.
And how did Canadian refining look specifically?
Canadian refining had a fantastic quarter, hit a new record for crude throughput, 112,000 barrels per day. And get this, utilization was 104%. They were really pushing it.
Over 100%. How does that work?
Yeah, they even tested capacity above the official operable limits at the upgrader for a bit. Reached 87,000 barrels a day versus a capacity of 78,500. Shows they're squeezing out every drop of efficiency.
Impressive. And the U.S. refining side? Any similar highlights there?
U.S. refining throughput was solid at 553,000 barrels per day. The big story there was completing the major turnaround at the Toledo refinery.
How did that go? Turnarounds can be tricky.
It went really well, finished 11 days early, and came in at the low end of the cost guidance. A big win. And crucially, this marks the end of a really heavy maintenance cycle for Downstream. They've expensed almost $900 million in turnaround costs over the last 6 quarters.
So the path ahead is clearer now.
Exactly. They have a clear runway now to really show what that whole refining network can do through the rest of this year and into late 2026. Only minor maintenance planned.
Let's look at costs then, a key part of the downstream story. How did operating costs trend across the business? Were they able to control expenses?
It's a bit mixed, but the trend is positive. In the oil sands, non-fuel operating costs did tick up quarter over quarter.
Why was that?
Mainly due to those turnaround activities and slightly lower volumes during the maintenance.
Right.
But they fully expect those costs to drop in the second half. In Canadian refining, though, operating costs actually went down, came in below full-year guidance for the second quarter running.
That's good news. And U.S. refining costs?
Also saw a significant drop in per-unit operating costs.
Yeah.
It's a strong sign they're making real progress, driving down expenses and boosting reliability across the U.S. network, getting those fundamentals right.
And tying back to West White Rose and future spending, what's the overall outlook for capital investment? Are they still in a heavy spending phase?
No, they're clearly signaling the end of that phase. Cenovus is wrapping up a multi-year investment cycle that started in 2023 and finishes this year.
So what does that mean for 2026 spending?
They've been very explicit. 2026 capital expenditures will be, and I quote, significantly reduce. They pointed to a low $4 billion figure as a good marker for people building models.
Low $4 billion. That's quite a drop from the recent peak.
Oh, yeah. It signals a very clear strategic shift towards capital efficiency and really driving free cash flow generation. They're focusing on projects like, say, in Lloydminster, where they can spend maybe $150, $200 million for 10% growth that's profitable even at $45 WTI. Smart, efficient spending.
Okay, so let's bring it all together. We've gone through operations, financials, projects. What does this all mean for investors? What's the big strategic message Cenovus is trying to send?
I think the message is clear. This is a pivot point. Management is executing a plan focused on delivering higher production, yes, but with much lower capital spending into 2026. And the direct result of that strategy is expected to be a significant jump in free funds flow. They're positioning themselves as a powerful cash generator.
Right, so it's less about finding brand new oil fields and more about really optimizing what they have, finishing the projects they started, and letting the cash roll in.
Exactly. Unlocking value from the existing asset base. Narrows Lake improving efficiency, West White Rose flipping from spender to earner. That's the core of it. And don't forget those Asian assets, they consistently throw off about $1 billion a year in free cash flow with very little capital needed.
Just harvest the cash there.
Pretty much.
Right.
Harvest the cash, optimize the contracts. It's a stable, valuable part of the portfolio that often gets overlooked.
Okay, and on the refining side, given that focus on cash flow, what are they saying about margins and cost improvements now that maintenance is done?
They see a clear path forward. 3 main levers they're pulling for margins.
Which are?
1, optimizing the crude they run, especially capturing those wider, heavy oil discounts when they appear. 2, being smart about where they sell their products. And 3, just relentless focus on cost reduction. They admit they're not quite best in class on U.S. refining unit costs yet.
But they're working on it.
Aggressively, aiming for another $2 per barrel reduction over time. But, and they stress this, doing it smartly. Not cutting corners on safety or reliability.
That makes sense. Now, the Canadian policy environment always looms large for these companies. What was management's tone on that? Any signs of change?
They used the phrase cautious optimism, which, in this context is maybe more positive than usual. They actually noted more constructive engagement from the federal government lately, called the current government the most constructive in a decade on economic improvement efforts.
Really? That's interesting.
Yeah, but there's a but. While new project legislation might be well-intentioned, those big regulatory hurdles, the tanker ban, the emissions cap, carbon taxes, they still need serious work before major new investments really feel viable.
So potential green shoots, but still work to do.
That's the feeling, a potential positive shift, but the finish line for a truly competitive environment isn't clear yet.
Does that cautious optimism, or maybe the remaining hurdles, affect how they think about M&A? Are they looking for deals?
Their perspective is interesting. They believe a genuinely more competitive regulatory scene could change everything. It could attract more foreign investment, maybe boost valuations generally, and encourage companies like them to think more about growth, both organic and inorganic.
Instead of just focusing on buybacks.
Right, a shift from just returning capital to maybe pursuing growth again. But for now, they seem happy with their current asset mix, don't see any major holes to fill. Any potential deal would have to compete head-to-head for capital against their own internal projects, which look pretty good right now. So the bar for M&A is high.
Okay. And one last market fundamental check. Heavy oil differentials. Crucial for their oil sands business. What's their outlook for the rest of the year?
They expect the TMX pipeline expansion to keep Alberta differentials pretty tight compared to the U.S. Gulf Coast through the fourth quarter.
So not much change expected there.
Not much domestically. Globally, they acknowledge that if OPEC Plus increases production, that might widen the Gulf Coast differential a bit. But they don't see it blowing out, maybe widening by a couple of dollars from where it is now, which is very tight, back towards a more normal long-run average, but nothing dramatic. So relative stability expected.
All right. Now it's time for our This Is Not Financial Advice segment. This is where we put on our imaginary hedge fund analyst hat and pitch an outrageous, maybe, but still plausible trade idea based on everything we've just discussed. Just a thought experiment.
Okay, let's get the gears turning. Given this whole picture, the end of the CapEx cycle, the project completions, the cash flow focus, here's a thought. What about considering a long-dated call option on Cenovus Energy, something expiring out in, say, 2027 or maybe even 2028?
Long-dated calls. Okay. Intriguing. Why that specific play? What's the core thesis driving that outrageous but plausible idea?
The core thesis is this. I believe the market is seriously underestimating how fast Cenovus can deleverage and how aggressively they can ramp up shareholder returns in the coming years. We just talked about it. They finished this massive capital spending cycle. 2026 CapEx is guided way down towards that low $4 billion number.
Right, the spending drops off a cliff.
Exactly. And at the same time, you have West White Rose flipping, going from that $800 million a year spend to an $800 million a year generator by 2028 or 2029. That's a $1.6 billion annual swing right there.
So you're betting on the market not fully appreciating that massive shift in their cash flow profile yet, that inflection point.
Precisely. You absolutely nailed it. Combine that huge West White Rose flip with the steady $1 billion a year from Asia, plus the downstream cost cuts finally bearing fruit. You could potentially see what I'd call a free cash flow supercycle for this.
Supercycle.
And that surge in cash could let them hit their $4 billion net debt target way faster than the market expects, which then unlocks even more cash for massive share buybacks or dividend hikes.
And the long-dated calls give you leverage to that potential re-rating.
That's the idea. It's leverage on the market waking up and fully pricing in this transformation. From a company pouring money into projects to a lean, mean cash returning machine. It's definitely an audacious bet, but I think it's plausible based on the numbers they're laying out.
That is certainly a compelling scenario to think about. What a detailed deep dive into Cenovus Energy's Q2. From handling wildfires with incredible speed to finishing major turnarounds early and really setting the table for serious cash generation ahead, it really was a quarter of strong execution.
It really was. They seem clearly positioned at a key turning point. Moving towards more barrels, yes, but with less spending and a clear focus on rewarding shareholders. It's not just talk. You can see the strategy and the disciplined execution coming together.
Well, we certainly hope this deep dive gave you a clear, useful, and comprehensive understanding of where Cenovus stands and where they might be heading.
Definitely. And just the usual reminder, this was all for informational purposes. It's absolutely not financial advice. We always encourage you, please review the company's own materials, do your own homework before making any investment decisions.
Couldn't agree more. Thank you so much for tuning into the deep dive. We appreciate you joining us for these detailed explorations, and we look forward to bringing you more insights very soon.